Hello and welcome to an FXTimes Daily Market Recap. I'm your fundamental market analyst, Nick Nassat. Today is Tuesday, March 16, 2010. We start today's broadcast with a look at the euro-dollar pair, which rallied in today's trading, especially during the European session and in early New York trading, recovering its losses from yesterday's risk aversion. We had European financial ministers come together for a strategy to give emergency loans to Greece in case its plans to cut its budget deficit fails. Also, we had a better than expected Germany ZEW Economic Sentiment Index, which helped bolster fundamentals and support the euro. The plan by the financial ministers from different European nations is a bit of a financial lifeline to Greece, and it amounts to a bet that perhaps they would not have to actually call it in. The plan did not specify the size of any loans, which countries would offer them, or how long they would last and cost. But they, underlying guarantee did help boost the euro in today's trading. We also had the S&P take Greece off its ratings watch, which affirmed its BBB plus rating. So all around some positive news for Greece, though again, like with most of the news coming out about that situation, there's a lack of clarity about exactly what policymakers in Europe want to do. We had reached the 1.3775 level prior to today's other big news, which was the FOMC announcement at 2:15 Eastern. And right now we're about 45 minutes after the release of that statement, and we've seen a bit of volatility with the pair testing 1.3775 as its high, but we have paired some of those initial gains, so we'll see where this, what will happen with this pair in the Asian session and in European trading coming up. Before we look at the FOMC statement, let's take a look at the German ZEW economic sentiment for the month of March, which fell to 44.5 from 45.1 in February, but that decrease was less than expected. However, looking at the Eurozone as a whole, we saw a worse than expected decline to 37.9. It's the sixth straight month that confidence has dropped. However, the index did not slide as much as forecast, which could mean that the fallout from Greece has been factored in and that investors and analysts are again looking at the fundamentals from the Eurozone, which showed some improvement recently, as we had seen in industrial production data that came out late last week. Here's a visual look of the index heading back to 2008, and we could see that in the fourth quarter of last year, this index had topped out and we had been trending downward the last 6 months. Moving on to the FOMC decision, as expected, the Fed kept rates at their ultra-low rates in a band between 0 and 0.25%. It also kept its language regarding keeping those low interest rates for an extended period of time. That means that rates should remain at their current levels for at least the next 6 months. The Fed said that economic conditions continue to strengthen, pushed up by higher business spending and a moderate rise in household spending, but there are troubled areas in the economy, including the high unemployment rate, flat housing starts, and continued contraction in bank lending. All in all, the statement lacked much in terms of surprises, and following its release, the Fed funds futures showed a 70% chance of a November rate hike by the Fed when the odds were at 84% prior to the FOMC statement. In other words, investors and traders are taking it as a bit of a dovish statement, and the greenback may be pressured as a result. There were some small tweaks compared to the language last time around, with the FOMC saying that the job losses, where last time they had said job losses were abating, now they said that the labor market has stabilized, so that's an upgrade to the labor market. We also had the increases in business spending flagged by the Fed, and it just seems that overall the FOMC is buying into the recovery story more strongly now. Now we see that in the back to the euro-dollar pair, the initial reaction was a push to an intraday high, but we have seen some choppy trading afterwards. So we will see if we're able to move above this very strong resistance now, around 1.38 in the euro in our upcoming session. Staying with the euro for a bit, let's take a look at the euro-yen pair. As we can see that the yen was a weaker performer today, as we had the news about the European finance ministers agreeing to some kind of package for Greece, as well as the better than expected Germany ZEW economic index, which came out around here. We were unable to reach our highs from yesterday, around 125, which remains a very strong level to watch. If we jump to a 4-hour view and zoom this pair out a bit, we could see that this 125 level had acted as support in late January following a very sharp slide. Then we had cracked below it, and we had retested it as resistance now twice. So like I said, this is a very important level, and if we push above it, then that could signal future gains for the euro. In a final look at a euro pair, here we're looking at the euro Swiss franc, which we had seen had plummeted the last 2 sessions, but today we have found some support around 1.45, and we'll see if this is just a pause before we have further declines, or if perhaps we have a bit bigger counter rally to these two period downswing. We can look at the pound-dollar pair, and we see that the pound rode this wave of risk appetite in today's trading, climbing from a low around 1.50 to push above the 1.52 level, the first time it's been above 1.52 since February 27th. Yesterday's decline now, if we plot a Fibonacci retracement of the most recent rally, we see that we had tested the 61.8% area. If we look at a Fibonacci of our fall from 152 to 140 below 1.48, we could see that that was a 50% retracement at the 1.50 level. So we're definitely seeing some pound strength now after the FOMC decision, and that has been the catalyst to break above this 1.52 resistance. So we should monitor that to see if we have a further move upward, and then we can lay out some important technical levels as resistance. Turning to our commodity-linked and growth-linked currencies, we're looking at the US dollar Canadian dollar pair, and we could see that it broke below our support from Friday around 1.0150 to set a new low at 1.0133. So that low has come in the wake of the FOMC announcement. So like I said, this has been interpreted as a bit of a dollar weakness in terms of the reaction to the FOMC. We also had a positive report on manufacturing shipments, which helped to support the Canadian dollar. In that report, we saw manufacturing sales for the month of January rise 2.4%, which was almost more than triple forecast of a 0.7% increase. Plus, we had December's figures revised upwards as well. We could see that since the start of 2009, manufacturing sales have been rebounding following their sharp slide in late 2008. The Aussie dollar, meanwhile, traded mainly sideways in today's trading as it was pressured by the RBA meeting minutes, which showed that any further increases by the RBA may come at a gradual pace. However, following the FOMC announcement, we did manage to move higher in the pair, which made this a very positive day for the Aussie as we started around here, the 0.9130 area. Our resistance now is rather clear, just below our 0.92 level, around 0.9190. So we'll see if we'll be able to break out of this sideways trading we had seen the last 5 sessions or so. We had another piece of pretty important fundamental data, which was U.S. housing starts for the month of February, and the annual pace of starts fell to 575,000, which was slightly better than forecast, and it does follow an upwardly revised 611,000 annual pace in January. The construction sector faced rather harsh winter conditions during the month, so that amounted for the decline in housing starts, but we've also been bouncing along the bottom for the better part of a year as the industry has been hobbled by foreclosures, and builders are having a hard time competing against nearly new homes being dumped on the market by burnt speculators and banks. So we could see that this we have been moving very sideways in terms of housing starts after we finished this decline to start 2009. It's not a surprise then that most of the job losses we have seen in the non-farm payroll report the last 2 months have come from the construction sector. Now let's take a look at the upcoming releases for Wednesday's global trading session. Tonight, Australia posts its WMI leading index as well as a measure of housing starts, while Japan releases its tertiary industry activity index, and the Bank of Japan decides on interest rates. It'll be important to watch if they announce any further quantitative easing measures. Overnight, the UK posts its claimant count change as well as its unemployment rate, and we will have Bank of England meeting minutes. Tomorrow, the US will post its producer prices, while Canada releases wholesale sales. And that will wrap up today's coverage of the Forex markets. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you good trading.